Hi, welcome to today's Arch Capital update. It's 2024, well and truly now, well into January, just about the Australia Day weekend. So in many ways, Australia gets back to work, so to speak, from this weekend. But of course, we've been back in here for a couple of weeks now. So I hope you're all well. Just want to give a recap on last year, what might lie ahead, some big changes are going on, even as we speak. So to start with, last year's returns were very pleasing. If you've logged in and had a look, or you've received your reviews this week, you'll notice that returns have been fairly pleasing. We look back a year, and perhaps the predictions for the year ahead were not nearly as positive as what ended up being. So again, another example of how forecasts, unfortunately, are never really too accurate. Useful to have a look at, but doesn't really, whatever people are saying today, really no one's really got much idea of what's going to happen in 12 months' time, unfortunately. So the good news is that last year's returns were pretty good. The sort of the standard, 60-40 portfolio. Not everyone's in a 60-40 portfolio, but if we benchmark that, model portfolios were about just over 11% return. So that's pretty good, and hopefully this year is a good year as well. Now, what we've seen last year is interest rates rise, inflation rise, and now we're starting to see talk of interest rates coming back and inflation perhaps easing. So perhaps things are looking a little bit optimistic, but there's always things to be concerned about, not to be too negative. But there's always some signs of, okay, is everything going to be that good? So a little bit of warning when everyone's optimistic that perhaps just be cautious. Again, not trying to be negative about it. So anyway, that we're looking good. Returns are certainly good. It's always nice to start the year seeing those sort of numbers. A big part of the returns, I'm just going to duck out of the screen for a second here. If we look at last year's returns, now that's going to be a little bit small. I'll bring that up. A lot of the US returns, and the US market was really strong. They're talking about this Magnificent Seven. So I'll send these around, but the Magnificent Seven is the sort of the big tech stocks in the US, and that's what's really driven the returns. Again, a bit surprisingly, when people thought interest rates were going up with inflation, they actually expected this time last year those stocks might be doing it a bit tough. But those stocks are your Apple, Microsoft, Google, which is listed as Alphabet, Amazon, Nvidia, which has been a star performer last year. It's a chip maker, Meta, which is Facebook, and Tesla. So those 7 stocks have driven a lot, and their earnings and their what they call their book to market ratios are way above the rest of the market. So it doesn't necessarily mean they're going to collapse, but there's some signs there that maybe they're a bit overpriced. Who knows? But again, expect perhaps that things might normalise a little bit in that space. But having said that, global markets are looking okay, and we've seen some pretty good signs across the board of global numbers. Perhaps China's numbers, as always, no one seems to really understand when they release their numbers. They always seem to hit their target, but there are certainly some signs of Chinese growth being a bit under pressure in their property market and things like that again. So watch that space. And a big thing in the market this year is the US election. Now, luckily, markets over time have not been as affected by the US president as much as we might think. This election looks like we're going to have Trump versus Biden, really interesting times in the US, lots of tension over there. So let's see how that pans out, and let's hope it doesn't make a huge negative impact on the world and markets for investors. Again, just going to drop down to the letter here. You might have seen in the letter we sent out, if you have received this week, if not, you should shortly. If not, reach out. Again, pretty small, but some of the positive indicators in the Australian market, I'm just going to pull that up a bit closer. Those charts are a little bit hard to see, so I'll just talk to them. But you can see the first chart there is the unemployment rate. The unemployment rate, which is this one over here, is still very, so in Australia and most markets around the world, there's sort of full employment when they talk about that. If you want to get a job, you can. So normally when we see signs of recession, that they're behind employment, and we're just not seeing that. So full employment, lots of immigration in Australia, lots of work around. So that's not causing this sort of recession. I think a lot of people expected there to be perhaps more tension in the market, interest rates going up. There is cost of living pressures, but we're not seeing unemployment. So that's good news. Inflation soared up. We saw that back at the end of the year really go up. That's why interest rates went up, and now we're seeing that ease back quite a bit. So certainly coming back down, still a lot higher than we've seen in many years. Not saying it's low, but it has come back a bit, so that's pleasing as well. So that's helping things along a bit. So they're all fairly positive signs. What we would say is going forward that expect uncertainties again. That's all we can do, is we can expect uncertainties. We know that we use a very disciplined and robust process that gets us through the good markets and bad markets. Unfortunately, I can't sit here and say I know exactly what's going to happen this year ahead. I wish I could. But what we do know is the process we use has worked for many, many years now and got us through really good years and bad years. So, there's some really positive signs. So I think overall, things are looking okay. Slightly away from markets, in today's financial review, there's a really interesting section of the wealth section on the online AFR. It actually lets you play with some of the numbers. The physical version just gives some charts, but it talks about how much you need in retirement. It's a constant question we have from people: how much will I need? How much do people normally spend? Of course, everyone's slightly different. There are some numbers out there, but I'm just going to share that with you as well. And it's quite an interesting little tool. You can actually, on the online version, you can actually play with this. Again, a little bit hard to see on the screen, but you can choose, for an example, it gives examples. So self-funded couple, got $1.6 million in super, and these charts here show their money running out. It sort of runs it to their life expectancy. So whatever life expectancy tables are at the moment, which is sort of that early 80s, that doesn't mean everyone drops it at 81, 82. It means some live longer, some less, unfortunately. So if you had $1.6 million in super, you could spend between 100,000 and 90,000 a year, and your capital will be depleted when you leave the planet. If you or a couple with a bit less in super, say $1 million, then it worked out that you could spend around 85 to 75,000 again, depending on some variables. So it sort of gives a bit of an idea. We have a tool that we use in a lot of meetings that we throw up on the screen. More than happy if this is a question that again you just want to revisit. It's quite helpful, and there's some good stats in here around that might be helpful. So again, if you go to the AFR, if you haven't got that link, happy to share a link with you. We can share this article with you as well. Another big thing this week has been the tax cuts. So a big announcement by the Labor government that they're going to change it now. Tinkering with it, when you look at it, they're sort of rebalancing it. Cost of living pressure has made them really focus on this. Not so good for the high income earners, probably evens it out a little bit. Bit of a shame that it's sort of just tinkering still. I think a lot of people really are looking for some big time tax reform. When you look at the Australian tax system, the PAYG, the employed people, actually take a lot of the burden. It's probably a little bit unfair in that sense. So when they talk about fairness, it's really the people who are paying salary earners, or I think over about 50% of Australia's taxes received that way, and it's going north, which is very high from world standards. So probably one of the more tax reform things is how they sort of even that base out so it's evenly spread across more people rather than just the sort of PAYG. But anyway, that's been announced. It does affect, and it considerably affects those on high income earners coming into the year. It hasn't been passed yet, but you expect that to get through. And the new tax rates will be, again, that sort of 37% rate really hits that band of 135 to 190, which will sort of going to disappear, that band. That's pretty much it today. There's another little interesting booklet that we've got here if anyone would like a copy. It's again reinforcing markets work. It's a little story around some of the philosophies we constantly talk about and some of the principles around market returns and history. So if you want a copy of that, reach out. We can send you that electronically or a physical copy. It's a much longer video today, so if you've listened to the end today, thanks so much. Really looking forward to the year ahead, looking forward to talking to you, meeting with you soon. If there are any questions from today's session, please reach out and we can send you any of this information. So again, welcome to 2024. Hope it's a great year for you. Speak to you soon.